Good morning. I'm Jim Barlow of OakTree Premium Finance, and today my presentation is The Alchemist, transforming life insurance into a wealth building strategy. Let me begin by telling you a little bit about myself. I graduated from BYU in 1975 and went home to Clearfield, Utah, and joined my father in his furniture store. I stayed there for 8 years with Barlow's Furniture. In that 8 years, my father retired and subsequently passed away, and it became my business. And at the end of 8 years, I decided I could not compete with R.C. Willey's. So I went into the investment business and was an investment advisor for 35 years until they say it was time to retire. Sold my practice and tried on retirement and couldn't handle it very well. So I started OakTree Premium Finance. And maybe that's a little more background than you wanted to know, but here we go. Let's get started with The Alchemist, transforming life insurance into a wealth building strategy. For centuries, let me get rid of that thing at the top there if I can. For centuries, alchemists dreamed of transforming lead into gold, believing this miraculous change could unlock both immense wealth and deeper enlightenment. Well, today I'll introduce to you a way to transform life insurance from a traditional safety net into a powerful financial strategy. Much like the alchemist's quest to turn lead into gold, you'll explore how life insurance can be used to build financial security and unlock wealth building opportunities. By the end of this presentation, you'll have the tools and insights to take the next steps in exploring these strategies further, perhaps even becoming a modern alchemist yourself. So welcome to the new alchemy of wealth creation. We're going to be blending life insurance, an indirect investment strategy, and banking into one powerful, alchemized approach for exponential wealth building. Caramels, homemade caramels, or purchase the Heavenly Caramels in Ogden, Utah. You blend butter, sugar, cream, precise heating, careful blending, attentive stirring, and voila, these simple ingredients become something rich and delectable. I like caramels. If you're at one of my presentations, I have a bunch of these Heavenly Caramels on the table. There's a lot of alchemy is going on in today's world. In the 1980s, we had personal computers, the digital revolution, the 1990s, the internet, 2010s, augmented reality and virtual reality, mid-20th century, nuclear fusion, 21st century, electric vehicles, 21st century, also artificial intelligence, genetic editing, and there's some of the modern alchemists of our today. It's an exciting time. There's better ways. Let's see if we can find some. After I retired and eventually started OakTree Premium Finance, I started going to insurance conferences because I dropped my security licenses and discovered a company in Texas called NIW. And they have built a product they call Kaizen. Kaizen is a Japanese term meaning continuous improvement. And I think that's what we hope life is about, always getting better. Well, in their Kaizen, this is an alchemy itself, where they want to give people more income, more money, more protection, more confidence. I'll be referring to Kaizen throughout the presentation. The qualifications for Kaizen, there are some. Let's get this done up front. There's an age range, 18 to 65. They will not sell it to anyone over 65. Health underwriting, they have to qualify as standard or better health underwriting, pretty high levels. Then you need to have some financial criteria. All in one's life is tougher. 100,000. If your income is 100,000, 199, you need a minimum net worth of $1 million. If your income is over 400,000, no net worth requirements. National Life or other major vendor, at least 100,000 income, no net worth. And you need to be able to have some financial capacity. You must be able to make annual minimum payments ranging from 20,000 to 40,000. That's the minimums, depending on your age. And don't want to spoil things too much, but it's for 5 years. And then long term, should be able to commit to at least a 15-year period before accessing benefits. The funding part is going to take place over 10 years, and we need some time for this to simmer, to grow, at least 5 years. If someone doesn't have this 15 years, then I tell them they should not purchase this. We can't pull this alchemy for them today. But for those who have that 15 years, you're going to see that this is pretty amazing. The applications of Kaizen is really, really broad. Kind of the red, kind of did a color code thing, is the individual. Well, maybe not true. Let me start with the blue. The supplemental retirement income is the #1 reason people purchase this, to give them more money for their retirement. And it related the other blues, but family wealth gifting, this is a wonderful way to give wealth to the next generation, or as an employee benefit to retain your employees. I've kind of listed a few of the applications, but it applies to a lot of cases. Just yesterday, I asked AI to draw me a picture of a multi-unit item. That's what the Alchemist built for a cell phone maybe 3,000 years ago or whatever. Anyway, it looks kind of pretty. So let's get started. Life insurance. Life insurance is protection primarily, and you're going to see how it's tax efficient. So here's the 4 bullet points that I want you to understand. Death benefit. Life insurance hasn't been around forever, but it's been around a long time. First term policy, 1759. First whole life policy with cash value, 1842. This is to protect your family. Here's the best quote I found on life insurance. Life insurance is the explosive expansion of capital at the exact right time, paid to exactly the right people and the exact amount that you want them to have. Found that quote a number of years ago. I like it. That's the #1 reason for life insurance: protect your family. The #2, notice living benefits, 1980s. Before 1980s, this isn't something that was available. Access to a portion of the death benefit for terminal illness, chronic illness, critical illness, long-term care. Let me show you explain this a little more further. Let's take chronic illness first. This is your long-term care type thing. If you can't do 2 of the 6 living daily benefit things, then you could qualify for long-term care. And this will pay you 80 to 90% of your death benefit if you can't do those things. So your death benefit becomes a living benefit for when you're alive. Terminal illness, critical injury is a little bit different in that they'll pay you a lump sum. If you're terminally ill and you have $1 million policy, they'll pay $800,000 and $900,000 up front. You're getting your death benefit early. Or critical illness, cancer, heart attack, or critical injury, severe injuries. This is a major reason why people should be buying life insurance, the living benefits. Another major thing about life insurance is the tax advantage benefits. Death benefits are generally tax-free. The Revenue Act of 1913 is the act where we started income taxes. And part of that act was that death benefits from life insurance are tax-free. Has been from then, and it has not changed ever. Another couple of things, cash value grows tax deferred. That's the Internal Revenue Code number. And withdrawals, loans can be tax-free. And that's how we can make life insurance, a retirement benefit, tax-free. This CPA in Minnesota said the single biggest benefit in the tax code is the income tax exemption for life insurance. You should know about how to use it to reach your goals. Tax-free this is really something cool. Oh, let's see. Let me go. No management fees. I'll have to give another slide there. You know, there's certainly life insurance costs in life insurance policies, but there's no advisory fees. There's no management fees. And eventually this can become a big deal in saving lots of money. So get back on track here. So this is our summary slide. We'll be doing this throughout the presentation as we add on the other two areas, but you can see that life insurance reduces financial vulnerability risk, reduces tax risk, reduces fee-related costs. That's the first benefit of this alchemy work we're going to try to do. I should mention, there are some other tax-free avenues in our world. There's municipal bonds. I sold a lot of municipal bonds in my career. So a lot of municipal bond funds. Roth IRAs and Roth 401ks are limited, but you can put money into something that's going to be tax-free. I recommend that everyone has Roth IRAs or Roth 401ks. 529 plans, as you pull the money out for education, is tax-free. That's the other tax-free avenues other than life insurance. Let me give you a little history on life insurance. As we already mentioned, term policies started in 1759, whole life in 1842, and it wasn't for over 100 years until changes started being made. Variable life came into being in 1955, and this is like buying mutual funds inside a life insurance policy with ups and downs. And I put down a caveat that you need to be security licensed to sell them. I used to sell those. In 1979, Universal Life was invented, came out, where you have more flexibility with premiums and benefits. Then living benefits, as we've talked about, came out in the 1980s. Then variable universal life, more flexibility on that variable life we mentioned, came out in 1986. And then the most recent is 1997, Index Universal Life, which links growth to market indexes. And that's the product we're going to be highlighting and showing you how it can be wonders for you. So We have life insurance. Now we're going to do this indirect investment strategy, index linked upside with no market losses in that index universal life. Now, to make this make sense, we need to have a hypothetical client profile. We need a case study to show you how the numbers would work. So I'm going to take a 45-year-old male, excellent health, non-smoker, annual income 240,000, retirement savings 500,000, and he's willing to put in 50,000 a year for 5 years. And he'd like to have distributions income from 65 to 90. We're going to use an illustration rate of 6.72. The NAIC, National Association of Insurance Commissioners, regulates what interest rates can be illustrated, and that's the current one. We're going to do an income tax rate of 37%, long-term capital gain of 20, and a state income tax, we're going to use an average of 5.5. Interestingly, the average age of people who buy Kaizen is 46, just around this 45-year-old. And interestingly, the average amount they put in annually for 5 years is 70,000. So this 50,000 45-year-old is not an unusual scenario. But we're going to use this and run the numbers. Let's talk about a little bit of comparison performances. Let's start with the S&P 500. Over the last 20 years, it's averaged 8.7%. If you have management fees of 0.5%, that'd be very conservative, advisory fees of 1, then you'd be netting 7.2. And if you're paying taxes at 20% long-term gain rate and 5% state of 2.04, you'd be netting 5.4. Got that information on the performance from ChatGPT. If you're in a balanced fund, you'd be 6.3, and that's where most people should be. They should be 100% stocks. So your net would be 3.6 over the last 20 years. The very first Kaizen policy was issued in 2012, and its average from day one, 7.73. And that NAIC number I was showing you just a second ago is 6.72. So you can see that the 6.72 is a competitive rate compared to everything in this world of investing. On my website, I have built a retirement income gap calculator. This is my ideas, how it's structured, and I got a computer geek to help me put it together, and it came together well. I'll go to it in a second and show it to you on my website. But here is the fellow we're referring to in our example. So he's 45. We put that in. 65. That's a default age I have on the program, but you can change it up and down. You have an inflation rate, and I have a default of 2%, but I put it up to 3, and I put his current income. The average person in our country needs 80% of their current income in retirement. So I did that calculation. If you don't want to do 80%, you can change that. And with that, then I had a 500,000 in how much he saved towards retirement. We put a growth rate of 7. We can change that. We can change the age which he wants to have the income quit through. So doing the 240,000 income, 80% and 3% inflation, his goal at 65 is 346,773, and his 500,000 is going to grow to 1,934,000, and he can get a million. He can get 140,272 income starting at age 65 as he gets a 7% return And we're going to be using every penny through age 90. If that sounds easy to say 90, when you do your own, you could do 95 or whatever. But so this guy has a shortfall of 206,000 per year that he needs to solve for. But let me change to my website. Get the cursor to go to the right place. This is my website. And as you scroll down, here's the latest presentation of The Alchemist. I'll be replacing that one with this one. And we can go to Retirement Income Gap Calculator, the quick link right here. If we click that, we have the calculator. And so you can put in your age. Let's say, but we don't want to do 45. Should we do 35? And let's say this person wants to retire at 60. We can change the inflation rate. We can put in the annual income. Let's say his income was 200,000. And with that 80%, we've already calculated what his goal is over here. He wants 335,000 starting at 65. And let's see, how much has he accumulated? Well, he's younger. Should we say 200,000? And with the 7% growth in the market, that'd be a grow to 1,085,000. If we think we can get 8%, we can, oops, I keep going the wrong direction. 8% will have more, and his income based on that amount would be 99,507, shortfall of 235,000. Oh, and what if he wants to retire, have income through, or I'll even put 100, let's say 100, then it would give an income of 91,000 from 65. This calculator on my website is totally free. It's just yours. You can go to it and use it anytime you want. It's just there. We don't record your numbers or anything. So use it. Let's go back to the presentation. Oh, I saw the same screen. It's the screen now. Okay. Another software that's very helpful for people is the founders of Kaizen, NIW, created this site. They call it ILIA, I-L-I-A, Interactive Learning Information Assistance. And you have to have a login and a password. You can see that I'm showing you my login. And I'm going to show you how this could be of help to you. And I can send you an invitation to have your own login and password to look it over. What I need to be able to send that to you is your name, your cell phone number, your email address, and your date of birth. And then I'll send an invitation. You'll get an invitation from my ILIA, and you can play with the calculator that I'm going to show you to your heart's content. Once you're logged in, this will be your main page. You're on the left, you're going to have a lot of indexes of things you could look up and read about, videos you watch. The one that I go to all the time is Estimate My Benefits. This is the calculator part of this program. And on the Estimate My Benefits, they have two versions. They have the Quick Result Estimator. You just need to put your age and sex and how much you want to put in per year, and it calculates the numbers. And on the right, they have a custom one where you put in more detail, exact birthday and things like this, to get a very detailed one. Once you do that one, you can get a proposal, a Kaizen proposal, which is 8 pages. And you can also get inside that proposal, you'll have all the illustration and numbers of what it looks like. Oh, there's a page missing. Oh, there it is. It's out of order. You'll also have a 37-page report from the insurance company that's willing to issue the policy. This is from Allianz. So I'll have to change that. All right. So back a few slides out of order there. Okay, so back to this hypothetical fellow. At the 6.72 return, after tax, that would give us he'll get an income starting at age 65 of $41,017. And from 65 through age 90, he'll pulled out $1,066,000. And that was $50,000 a year at age 45 for 5 years. And that's what he gets. If he did this in an IRA, 401k, it's another 10,000. So deferring taxes helps you have a higher income later. That's the reason for retirement plans, and that's the reason the government has it. That's the form of alchemy. Same return, getting $10,000 more because you deferred taxes, and you get $1,345,000 total from 65 to 90. We're going to be going back to see all the blank places underneath. We're going to cover all that. So the details about indirect investing. Here's the bullet points I want to cover here. A little bit about that life insurance. We had the term life and whole life introduced in those years, and we're going to be using the index universal life, which combines growth and potential growth, and is very, very turnkey. Minimal management, annual decisions only. You do have some others with Allianz, but very don't worry about it type thing. And the growth and protection cash value grows in the insurer's account with index options providing potential gains subject to caps and participation rates. I want you to understand this section first. So, beyond the cost of insurance, let's say there's $1,000 going in, and we're in a 5% interest market, $952 would go into the general fund of the insurance company, high-grade bonds, and $48 would go to the option budget to buy market performance. So the $952 in 1 year is going to grow to $1,000. You protected your money, you can't lose. And then the $48 you put in indexes to mimic the market or even outperform the market. If we're in a 15% world, then we're going to put less in the general fund. We'll have more to go to the option budget. This means we can buy more options on the market. So when interest rates are going up, it's actually good for index universal life policies because you get more upside potential. I want to show you how those work there. So we're going to go to the index options, or we're going to use Allianz as an example. But the bullet points are you're going to have some funds that are capped. You're going to have some with a participation rate. And we have some other, excuse me, some other options. So here's we're going to use Allianz, as I said. If one option is to put your money into the S&P 500 index, and they give you 100% participation, but they also cap your return. So meaning in a year that performs at 15%, you just get the 12.5. So that's a capped return. The average in this area for the last 10 years has been 8.2. We have other options, not tons, but there's 5 you can see. One of the first ones is an SP 500 futures index. And here you get 80% participation, but no cap. In the last 10 years, this would be a return of 10.82. Then they have a blended futures index, US and international, that they give you 120% participation rate, more than the market, and that is average 8.87 for 10 years. And then they have some volatility controlled funds, both Bloomberg and the PIMCO. These are much more conservative, and you get much more higher participation rate because they're so conservative to bring up the averages at 907 and 8.74. Once a year, you can change your mix and how you want to do it. If you blended all the last 4, last 10 years, you'd be 9.38. They also, with Allianz, have bonuses. And if you go with the S&P 500, they don't have a bonus on that one. But if you go to the other funds, you can either have a 1% guaranteed bonus, or you can do a 15% multiplier. These are no additional charge, or a 40% multiplier with a 1% annual fee. This is unique to Allianz, different options. An interesting thing is that currently the National Association of Insurance Commissioner illustration guidelines do not allow us to show multiplier illustrations. So the number we're comparing with the other investments you showed is that 1% bonus. Allianz also has some interesting features, index lock, where once a year, not on your anniversary, you can say, I want out of the market, go to money market, protect your money. And they have an auto lock. These are things that nobody else has to help you manage your money. So here we have that guy, and we're going to add on index universal life with the same performance numbers. And the number is, oh, I forgot I did that. First, you've got a life insurance policy at age 45 of 793,000, and then your income starting at age 65 is 61,000. So by using a life insurance policy, we've got life insurance, plus we're going to have a higher income than the after tax or the tax deferred. And at age 90, we still have a death benefit of 470,000. So we're at a different level of alchemy. Life insurance can give you some good performance numbers. So here's our next summary page. We've added the growth benefits. Market downside protection, there's no downside. Market linked growth, either with the capped or the other. Lost my memory there. Where we have flexibility. I didn't mention this majorly, but you don't have the required minimum distribution rules like IRAs and 401ks. You have a lot more access to your money than any other way. Now, what if I just took off the life insurance benefits for a second? And what if we're just looking around in the world and say, well, here's an investment that has no taxes, no management fees, no advisory fees, no downside, and we get market returns and flexibility. You'd say, oh, this must be the most perfect investment I'm ever going to find. And then when we say, oh, and by the way, you have life insurance too, wow, this is the best thing since life spread. You've heard that phrase before. So there's what that does. So life insurance, indirect investment strategy with an index universal life. And now we're going to go to banking. Leverage contributions for accelerated growth. Let's take a break for a second. Mortgages. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. Wow. 1934, the Federal Housing Administration was created, which revolutionized mortgages and home ownership and gave us 30-year loan rates. And from 34 to 62, 120 billion was financed. And it's even more today, 16.96 trillion. And this is even old numbers, 2021. 140 million home loans. 63% of US homeowners have a mortgage. This was not the case before 1934. Mortgages have improved our society, improved my life, improved probably your life, rather than having to rent for a long time or whatever, or live in the basement of your parents. Maybe that's still happening sometimes. Anyway, mortgages are a big deal. It was revolutionary. So why are we not using leverage for retirement? If you can get an investment with tax-free and no downside, why not use leverage? So here's Kaizen. Kaizen is 5 payments. And we're going to get a bank to match approximately your 5 payments for the first 5 years. Then you're done. And then the next 5 years, the bank is going to continue to make their payments they were paying and the payments you were paying. So we say approximately 3 to 1. If you're putting 100,000 in, they're putting in about 300,000. This is the leverage we're talking about. So the very first policy was issued in 2012, and on a statement of June 26th, this last summer, the average return on this first policy was 7.73, and the average borrowing cost that they paid is 3.81%. So this first policy has made 3.92% on the borrowed money, on the 3 to 1, the 300,000, that quick number. And interesting, we've done some back testing to 1930. There has never been a 15-year period with less than a 2% spread. Oh, certainly there's years where the market is negative 37, like 2008. And so in an index universal life, you'd have 0, and you'd still be paying interest. But over a 15-year period of time, there's never been a time less than a 2% spread. And the first policy has had a spread of 3.92. That is the alchemy that will give you more money in retirement. Here's an interesting statistic, kind of not related totally to what we're talking about, but important for you to know. 26% of your performance on your investments is based on the performance, the number you got, the 8% or the 7 or the 9 or 10, and the money you'll have for retirement. 74% of your financial success is due to just having money in the account. You probably knew that. You knew you had to put money in, but investment advisors, including myself for 35 years, were trying to outperform the market, get a bigger return for my clients. I wasn't really helping them have more money because that's a little difficult. But here in Kaizen, we're going to give you more money. Here's a spreadsheet from that 45-year-old, and you can see the 50,000 he's putting in per year for 5 years. You can see the bank's putting in 44,554 for 5 years. Then they're upping theirs to 93,000 for 200 for 5 years. And I'm going to show you this spreadsheet a little later, but that just shows you the actual money going in. And we're doing this with no interest payments on your part, no loan documents. You're not doing the loan. No credit checks, no personal guarantees, not even a signature, no collateral. The way we've structured this, your policy is adequate collateral for the bank. We're the only entity that does this and can do this. So there's not a lot more risk. So this is our laundry list after the fact. So we have the leverage, 3-to-1 leverage, allows funding without required traditional collateral or personal guarantees. 5 annual payments. And then we have trust ownership. This is one of the things we put together to have this thing work. Let me go into that. So here's how we structure the ownership. We set up a living trust for each participant. And this living trust is managed by Provident Trust Group, independent third-party company in Las Vegas, big company. They manage over 12 billion with that and 31,000 clients. They oversee the policy until the loan with the bank is repaid and provides the annual reports. The Index Universal Life policy is used as collateral for the loan that funds the premiums. The structure protects the assets, shielding the policy death benefits and cash value from creditors. In fact, one of the side benefits is that being this company is in Nevada, they have the strongest creditor protection laws of any other state. So you're safer than having this trust in Utah or wherever you might be. There is a fee to this trust management. It's $7,500. It's paid $1,500 over those 5 years. It's in place for the 15 years with the Provident management, but you pay it all in the first 5 years. Then there's a bunch of additional features. These are things we tweaked, changed to make this all work. I won't explain death benefit option B, supplemental term rider, enhanced liquidity rider, loan protection rider. We've done a bunch of things to make this all work. And if we sit down and you want to know more about those things, I'd be happy to help. But more than we want to do tonight or today. So I went back to this statement again. I want to just point something out to you. If you go across that first year, we put in 50 and 44, that's 94,000. And notice the value at the end of the year, 81,000. If this was a normal index universal life policy, the value would be lower than that. Insurance pays expenses upfront. But we've actually mitigated this to make it, but it is still 81,000 compared to 94. And you can see that if you decide to quit, the bank would get their money back and you still get 34. That's not 50, But this is the point here, as I want to show you. For the first bunch of years, there's insurance costs. And as you become a long-term player here, it works out wonders. Fees. In the investment world, ETFs have about internal fees of 0.2, index mutual funds 0.12, active managed funds 0.89, hedge funds 1.5%, and advisors usually charge 1%. So total fees 1.25 to 2.5. Active managed funds 1.5. So these are the fees you're eliminating in a life insurance policy, but you still have the life insurance costs. Here's the life insurance cost. For the first 10 years, you have the premium charge. Covers the insurance administration costs, issuing and maintaining the policy. Then you have rider charges for 12 years. You have per unit charge for 15 years. But notice all those come to an end. And then there's the cost of insurance through age 95, then a minor policy fee. So the costs are upfront. I wanted to show you these charges. This is on the Allianz illustration pages. On the right, I actually hand calculated these. I like to put together a calculator to do automatically. But for the first year, your costs are 18.8%. Second year, 7.4. Third, 5%. And you can see that I put the 1.9 normal management fees for a mutual fund there in year 9. So year 9, your internal fees are starting to go lower than what you're paying in the investment world. And you can see it gets way down. Oops, sorry. Oops, wrong way. 0.68 in year 15, 0.27 where the 1.12 never ends. So we have the Index Universal Life annual income, and now we're going to do the Index Universal Life with Kaizen. And the drum roll, please. Is it going to be 71? We had 41, 51, 61, 71, 81. Well, it is, sorry, 98,000. Here's where some alchemy really took place. 98,000 income compared to 41 for after tax, 51 or 61. 2,448,000 income, and we still have a death benefit of 1,289,000. And if we put income through 100, this would still be working. So here's where the alchemy starts. Now, we want to test this to make sure this works. So we looked at the Great Depression, the 30s, when the market was so bad, and also the high interest rates of the 1980s. So in the 30s, 30 to 32, the stock market lost 70% of its value. It didn't recoup until 1959. If you could have something with a zero in the bad years, the Great Depressions that our stimulation, we're stimulating, our stimulation is that we have 9 out of 12 years at zero. And so would Kaizen work in the Depression? Oh, what about the 80s where interest rates got up to 16.88%? Would it work there? Well, here it is. 1980, 73,000. Stress tested numbers for the Great Depression, 63,000. Higher than the 41, 51, 61. Wow. Even if we don't get this 6.72 we've been illustrating for, this actually works still. Allianz did a study to see how good is these Kaizen numbers. They found that 7% of the time, the performance is going to be less. 93% of the time, probability of the same or higher. That's pretty darn good. An 80% chance of it doubling. Wow. 80% chance of the numbers double? Well, I couldn't help myself. What if you got a double? Instead of 98,000, you got 196. This is major alchemy. And turnkey, very little efforts on your part. This is, I think, is the the greatest concept. What if, come 65, you said, shoot, I don't need this. I don't need an income from this. What if I give it to Weber State? Or just leave it for my kids? What's the benefit there? Well, the death benefit of age 90 is 4 million on an index universal life, and the death benefit on the Kaizen would be 7,901,000. More for your kids, more for the charities, whatever you want. If you don't need the income, you don't need to take it. So we've done life insurance, we've done the indirect investment strategy, we added banking, and we created some alchemy. And there's our summary page where we've added the banking, substantially reduced capital outlay, reduced payment fatigue, reduced liability risk, reduced management complexity risk. Pretty exciting. So here we go. If you had questions, I'm actually recording this without an audience today because I want to get this on my website quickly. So there's no questions today. But if you decided to come to one of my dinner presentations, here's where you could ask questions. I've also done a hypothetical, all those numbers for a 25-year-old. What if you do this for your daughter at 25 and instead of 50,000, you do 22,000 a year? Well, here's the numbers. So just 22,000 a year for 5 years would give her at age 65 201,000 income. Wow, and 5 million outlay from 65 to 90. What if you offered it for your employee, your 35-year-old employee, and you went with the very minimum here of 21,600 for this 35-year-old, and you could do this all say, Bill, you're so important to me, just you, that I'm going to do this for you. That'd cement this person to your firm forever, I think. Or you can say, hey, Bill, I'll pay half of this if you'll pay half. If you'll put in 900 per month for 5 years, I'll put in 900. So you can use it for all kinds of different things. At this point, I usually like to do some feedback from people. We go open up the actual portal and show you how it goes. Let's do that. I think we have the time. Let me go to my other screen. And remember, we left off on the ink calculator. So now I'm going to go here. I'm going to go to the secure portal, Kaizen secure portal, and we have my login. And so I put my finger on that login and we logged in. And this is actually the one for me. So I'm now going to go to the demo. I'm going to select Allianz and I'm going to select Kaizen. I'm going to start the demo. And I'm going to go to estimate my benefits. And right here, it goes to the quick estimator and we can select the age. I don't know. This we did some other. Let's do 40 this time. Male, and it automatically has a sliding thing of 40. I'll just leave that alone, but you could play with that, and you push calculate, and lo and behold, everything is just calculated. It shows the 5 piggies for the first 5 years, shows the bank and their investment, shows your contribution, 200,000. The bank's putting in 586. Then you can go to benefits and distribution. You'll see that you'll start with $1.3 million life insurance, and at age 65, this 30-year-old will be getting 115,000 per year, tax-free. 2,990,000 total, with the death benefit still of 1,464. And if we go to the comparison, we can see the numbers compared with the non-leveraged index universal life, 115 to 69, to an after-tax investment of 43, and a tax deferred of 56. Using the seven, using, I think the numbers changed since I printed this. Instead of 6.72 is 6.74, probably close enough. Anyway, and then you can go to the custom design, and you can new custom design, and you can put in everything you want. I actually put in, oftentimes when I'm just looking at things, I just put initials in, select a date, and go to this. But it takes a little time on this one. Once you have a login, you can play with this to your heart's content. I'll stop there for now. But that calculator is extremely helpful. Now we're back on the regular screen. Additional information. This is kind of a compliance thing. Additional index universal life policy. They're regulated by the National Association of Insurance Commissioners, like I mentioned. And you can learn more about compliance going to their website. And I can teach you anything you want and go over things. But there's information out there available for you. And this is the last questions. There's also the information on the portal information we need if you'd like to. I may send you an invitation. Appreciate your attending today. I hope it's been helpful and fun. And if you'd like to come to a dinner presentation, you can sign up on my website for that too. Have a great day. Bye.